WPP has cut its key like-for-like revenue outlook for 2009 as the global recession and the lack of a major sporting event this year looks set to hit the advertising sector. Now, the world's second largest ad group now believes revenues will fall 2% this year from its previous forecast of flat. Well, let's discuss this in more detail because joining us in the studio is Alison Stewart-Allen. She's marketing and brand specialist at International Marketing Partners. And we're also joined by Alfonso Morone, a partner at Value Partners Group. Thanks both of you for talking to us today. Now, let's just get some initial reaction to you from the WPP numbers we've had out this morning. Investors seem to be sort of reacting quite well, and shares are off about 5%.
Yeah, well, I think 2008's performance isn't quite as bad as people expected, so that's clearly reflected in the investors' views. I think the real challenge is going to be what their 2009 numbers look like, and WPP are going to need to be very clear how they're going to, how badly they're going to suffer, because they're definitely going to not do that well. The question is how they insulate themselves, if they can, from the downturn.
And Alfonso, what do you think the outlook will be like for the company in 2009?
Well, WPP, out of all the media marketing services companies, is probably the strongest in terms of position because of its multiple degrees of diversification. They diversified geographically with roughly 1/3 from the US, 1/3 from Europe, and 1/3 from what Sir Martin calls the BRICS and the next 11. They also diversified in terms of new revenue streams with a good 25% to digital business, and ultimately they are diversified in terms of mix of above the line and below the line advertising, including marketing services with the recent acquisition of TNS. So overall, I think they are well positioned.
Number of discussions, number of things you mentioned that I want to bring out. One is geographically. We've obviously seen, Asia has been certainly impacted because of the collapse of the US consumer. How is that feeding through in Asia to just sort of straight advertising and marketing spend?
There is, as Sir Martin himself has pointed out many times, a very strict correlation between the GDP growth of a country, population growth of a country, and advertising performance. And all the indicators for the Asian markets, especially India and China with the growing middle classes, point to the direction of a growing spend in advertising. So what they call a recession in China is a GDP growing at 6%, which I think we would sign up now for that. So while the trend will not offset the decline in Western markets, the outlook in those markets is still very positive.
Go along with that?
Yeah, I would go along with that. I think sort of another bigger issue, if you like, or challenge, if you like, is to persuade the brands that WPP works with that they need to keep investing in marketing and branding generally, and they need to keep their profile and their names in the market. And the tendency in poor economic times is for brands to actually slash their budgets radically, whether it's advertising, investing in research and development. So really the challenge for WPP, like the industry, is to...
Well, I mean, it's very difficult because I'm sure a lot of marketing guys know, look, hey, in a downturn, take advantage of a downturn to increase your market share. But frankly, if you're close to breaching covenants and, you've got to refinance your debt, you have no choice, though, do you?
Well,
you just got to cut spending.
I'm not so sure. You can cut spending on advertising, but what's happening and shouldn't be happening is that brands are also cutting their investments in other types of marketing, like research and development, when actually that's so crucial at times like this. The goal is to drive demand, because demand is clearly going away, and to not invest in demand generation activities is absolutely the wrong thing to be doing, and yet brands often do it this way.
I agree. We have to distinguish between within the macro picture, which certainly for 2009 is very bleak, and frankly in Western markets I think is even worse than what has been forecasted. For instance, in the UK, I do expect a total decline of advertising of some 10%.
Yeah, well, we saw that with the ITV numbers.
Exactly, where they are forecasting 20%. So my suggestion is we also have to break it down in terms of traditional media and emerging media, and there are structural effects which are going on in this sector, where some of the dollars are migrating from what we call the traditional media, broadcasting and print, into online and internet-based.
Well, that was going to come up to where are we right now with online? In this, as we go through this recession, is it holding up? is even online being cut? Is it still taking an increase? What's going on?
Well, I think what's happening is across the board, brands are cutting budgets for online and offline. Although the impact of online is higher and it's a cheaper cost per thousand, nonetheless, the budgets are budgets. And I think you're seeing equal declines in marketing budgets for both on and offline.
The web guys are feeling it just as much as
from
traditional?
my conversations with my clients, yes.
What is the situation like for the more traditional advertisers, the television, the radio, the outdoor sort of billboards? I mean, just how severe is the situation for them?
Yeah, we have to break it down by types of media. So, for instance, within print, regional newspapers are the worst performers because they rely mainly on what they call classified advertising, listings, which work very efficiently on the web, where you only pay if somebody clicks through your product. I think my outlook for regional newspapers is very negative. National newspapers, where there is more display advertising, which is more geared toward branding, slightly more positive, but still a decline probably in the region of 7 to 8%. Television is also suffering strong structural changes like the decline of audiences, although perhaps in this current climate, maybe watching TV is a cheaper form of entertainment. But overall, I think the big problem there is that, as you know, in advertising, half of the marketing budget is wasted. You don't know which half. Now, the problem is that the Internet is telling you exactly which half is wasted. And so I think a lot of money is going...
I'm not sure. Have we proven that Internet advertising is effective?
It depends how you measure effectiveness. I mean, that's probably a whole other topic. But frankly...
Well, we could spend half a day on that.
But click-through is one way of measuring. Absolute sales that result from seeing a web advertisement is another. The reason, though, digital is more accountable, if you like, in a way, is because you can directly track seeing the ad and making a sale. With offline, you cannot say, oh, I saw a billboard at a rail station and now I'm prepared, now I buy it. You can't correlate.
So let's just wrap this up. What is the most effective form of marketing or advertising at a company? You know, they've got limited, smaller budgets. What is the most effective way for them to find their target market? What are you advising your clients to do?
Target better. So go back through the data they already have, these brands have, and identify who is already your good customer base and be tighter in your description so that you can overlay that template on the population and be smarter about your purchasing.
Well, thanks very much for coming in here to share your thoughts with us. That was Alison Stewart, Marketing and Brand Specialist at International Marketing Partners. And thanks also to Alfonso Morone, a partner at Value Partners Group.